Clearly yields are higher. Is that a buy signal for banks, or as we're looking at all the banks other than perhaps one or two of them down today, showing that everything's going to be pressured if this trend continues?
Yeah, I do think banks still make sense here. We have a steeper yield curve at this stage than we probably thought we were going to get, but I think it gets incrementally steeper from here, perhaps not at the pace that we've seen in the last couple of weeks, and that should, in a vacuum, be good for banks. And we have just about the best household balance sheets that we've seen here in the United States, and that should be good on a forward-looking basis for consumer cyclicals as well. So we're still big believers in the recovery here. If anything, the strength of the recovery and the unexpected stimulus that we're getting, in addition to the efficacy of the vaccines, in a cumulative way, is sort of responsible for this mini tantrum that we're seeing in bond markets. So we still see this as a good thing. We still think investors should be, fully allocated, and certainly fully allocated within equities here.
The last month, the Dow's down 0.6%, the Nasdaq 100 is down 8.3%. Does that make sense to you, and do you expect that trend to continue in the short to medium term?
Yeah, tech's kind of become a long-duration asset here, I think. When we look at the outlook for growth being so strong and broad-based, at least for 2021 and maybe for 2022 as well, it probably makes those tech earnings somewhat less attractive on a relative basis. And so you've seen the relative performance of tech become negatively correlated with interest rates, which is a pretty interesting dynamic, and not one really that we saw for most of the post-financial crisis period, when generally rising rates was good for technology relative to the rest of the market. I don't know how long that holds. I think while we're in this very, very high growth period, some other sectors are going to tend to get more attention, like industrials. I think perhaps if we start talking about infrastructure over the summer, like banks, which we already mentioned, and the consumer cyclicals, maybe just because they didn't quite have the run last year, look better to investors right now.
So just to be clear, on tech holdings, should you stay in them for the long term and sort of ride out this period of volatility on rising rates, or would you be repositioning the portfolio totally into more cyclicals?
Yeah, directionally, that's what we're doing. We've probably gone from pretty far overweight tech to just maybe mildly overweight tech, but we still have that position because we think at the end of the day, the U.S. is a growth market. Tech's got this very large role in the U.S. market relative to the rest of the world, and that when we come out of this, which is going to be this sort of artificially high growth period because of the bounce, because of the stimulus, these stocks are still going to look very attractive to folks who are looking for long-term returns, not just over the next couple of years, but over the balance of this decade. Where's the bulk of the return going to come from in the U.S. market? We still think it's tech, but in the short run, we have been allocating more to cyclicals and away from tech.
You buying overseas equities?
We are, especially emerging markets. So this is a real key here. And the Powell comments, I think, today were quite interesting, because if you think the Fed is going to sort of lose its nerve here and tighten prematurely, which I think that chance is still very, very low, then you don't want to own emerging markets, because that means you get a genuine tantrum, higher U.S. rates, stronger dollar. All those have been toxic for EM, as we've seen in the last couple of years. But if you do think the Fed's going to stick to its guns, and they're going to come out in 2 weeks and say a majority of the committee doesn't think they're going to be raising rates for 3 years, then I think the road ahead for EM looks quite good. I don't know if the currencies are going to appreciate against the dollar at quite the same rate they've been doing, but EM equities tend to do very well in this sort of return-seeking, risk-on, synchronous global growth environment. So that's where we have our largest overweight in the portfolios.
Brian, Nick, thanks for joining us. Much appreciated.
Shepard Smith here. Thanks for watching CNBC on YouTube.